Which subject did you say?
Uh, French honors.
French, the
Foreign
language.
language. Yes, sir.
Okay,
Foreign
great,
language.
wonderful. Just a minute, I'm just trying to see where we were last time. Okay. Okay, so one question to you, Prerna. This whole area of this financial management that we're doing right now. So how familiar are you with these things? These little concepts which we were talking about, or is it absolutely new to you?
Sir, obviously it is very new to me, but all about know about finance management is that it is the process of controlling company's financial condition and to ensure the financial growth of the company. So,
Okay. Now, as a definition of financial management, okay, we go with that. But my basic question was, suppose when we are talking about these, different concepts of risk, return, present value, have you ever had a chance to look at these things? No.
no, sir.
Then in that case, now, I suggest you look at some of the older videos on YouTube, the older recordings, because we've been having these classes for the last, I think, 2 weeks, I think, Vivek?
Yeah, so
Huh. So you should have a look at the recording so that you understand what those things were. Otherwise, maybe on some day when maybe Vivek is busy with some other work or Deepthi is not there and you are there, if this happens, then we will take that opportunity to speak about that. I'll try to explain those things to you um, when we meet. Acha, today, just so that you understand, we are talking about a unit, the third unit. So basically, you have missed 2 units. Now, the 2 units which you have missed, try to get some sense about those 2 units from the PDF PPTs which you have with you. Apart from that, you also try to look at the recordings when you get the time. Okay, so, in some respects, I'll tell you, teaching, learning a language is one of the toughest things which you can do. Because in a language, when you are studying, you cannot, I think, there is very little scope for not understanding something. You have to understand. Otherwise, your sentences will not be grammatically correct. There will be many.
Yes,
So
sir.
in finance, in finance also, if you want to really, get interested in it, then it is necessary that you understand each of the different concepts. But where some complex understanding is not required, simply reading it and remembering it, that will help you. Okay, so uh, I just wanted to uh, just make that point. Let me share this PPT with you, and then we can continue. So, Vivek, I think we had finished compound interest, and risk and return also, I remember we had done, and we were coming to annuities. Okay. Now, in risk and return, this I'm doing, it will be a little revision for you, Vivek, and it will help, I think, Prerna to understand this basic concept. Just suppose I ask you, Vivek, to explain. Deepti, are you with us?
Yes, sir.
Okay, then can you try to explain to Prerna the concept of risk and return?
Sure, sir. In respect of business, risk is very important because if the business will not take the risk, there is no profit, which is the primary motive of the business. So risk is very important factor to get a return or a reward in from your business, and the main objective of the business is that only to earn the profit or return from the business. So risk is important. The higher the risk, the higher the profit happen.
Okay. Do you want to add something, Vivek? Anything you want to add to that?
Yes, sir. I will explain with an example. Just calculate something like that. If we had n number of pieces and we want to sold it, and we are the only the sole manufacturer of that product. We invest, example like that. We invest in a pen, and the costing is 7 rupees, 6 rupees approx. That according to that, we have to calculate what will be its market value. So here is our risk. We can say until we don't know the market value of that price of that pen, so we cannot sold it.
Okay.
In other cases like that, means current value of that product and the future value, what will be the of what the amount we are investing. That time, the best example you told, in huge amount, if we are investing, we don't know what will be the profit or loss. And recently, I saw a video, just one example of a shoe making company. They invest huge, means approx 30 crores they invest in their branding, manufacturing, and they opened their 17 outlets. Everything is okay. They just focus on the growth and the positive things. They didn't saw the negative things. If it will not be run, so then what could be the next? The business will shut down within 3 years.
Okay. So on that note, let me continue from there. So what I think Deepti and Vivek are both saying, Prerna, is that suppose you start a business, any business. Now, your intention or your motive for starting the business, of course, is to earn some profit. Okay. Now, let's say that you are learning French. Tomorrow, you start a little school for a language school where you teach French. It will be a business for you. Your skill is there, and you will try to promote that business. People will come, and you're hoping that in the area where you're, let's say, focusing on, or maybe you're doing it online, a certain number of students will come and you'll be able to teach them French, and then you'll make some profit out of it. But suppose for some reason you are wrong. What will happen? Students won't come. And if students don't come, then in that case, whatever investment you had made in setting up that little business of yours, you will lose that. And as a result of that, you will face a loss. On the other hand, if the students had come, you would have made a profit. So you have made every decision. What finance, the concept is very simple, that every single decision that you make, it may be made with an intention to make profit, but it can result in loss. It can result in loss. This is the basic thing which you have to remember. So there is a risk always. And the point which Deepti was making is that when the risk is higher, you will only take a higher risk when you expect the profits to be very high. See, when you want the profit to be very high, you're willing to take a higher risk. But when you don't expect profits to be very high, you don't want to take a very high risk. If you take a very high risk and then you want a very, very little money, then why did you take a risk? You should have taken less risk and earned little money. Normally, it is possible to earn a small amount by taking a small risk. If you want to earn something really big, then you will need to take a bigger risk. Give me a moment, I'll just switch on my fan. Now, this slide, you will have to look at it in that context. So what were we doing? Is suppose you make an investment of 10,000 in bonds issued by a company. So a company, when it borrows money, this is mainly for Prerna's benefit. When a company, when it borrows money, it gives those people who invest in that company, it gives them a certificate. That certificate is called a bond. Now, anybody who has that bond, he has invested money in the company, so he has a right to get the money back after a certain number of years. And during that period, he is expected to, the company is expected to give him a certain return. In this case, the company has promised a 10% return. Okay. Now, when the company says 10% return, it means, let's say the bond is will be returned to you after 5 years. The money will be returned to you after 5 years. Every year, on 10,000 rupees, 10% is 1,000. So every year, the company will pay you 1,000 rupees as interest. Now, my question here is this taking into account the time value of money? So I think both Deepti and Vivek will immediately say that no, it does not take into account the time value of money. The basic principle in the time value of money, Prerna, is that whenever we get money in the future, the value of that future money is less than the value of the money today. Because if you had the money in hand, you would have been able to invest that money and you would have earned something on it. But if you get the money 1 year or 2 years later, then between now and the time you get the money, you have no chance of earning money with that money. That is the basic point which is there. Is this risk-free? So when you invest in a company and it promises to give you 10%, is this risk-free? It is not without risk, because if for some reason that company, it collapses, it is unable to repay you, then you will lose your money. So there is always a risk. Now, a risk-free return, that is a return which is offered to you without any risk. Who can offer such a return? Only, if you look at it, only the government is in a position to offer a return like that, which is risk-free, because the government has the option always. First of all, a government is supposed to be strong enough to be able to meet its obligations, to always fulfill its promises. So if it has promised a 10% return, the government will give you 10%. But does the government give you 10%? No. Normally, if you go for a bond or something offered by the government, the return is much less. So basically, when there is less risk or no risk, the return that you get is much less. So first of all, remember that a risk-free return can only be offered by the government. What should the return be, higher or lower? Obviously, it will be lower. And so one rule here is risk-free return will always be a very low rate. Nobody can guarantee you a high rate without risk. There may be people who will offer you a high rate, but then be clear that there will always be a high risk which is involved. Now, then if the rate offered by the government, this is just an example, is 7%, this 7% is called the risk-free rate. Okay? Now, when you invest with any entity other than the government, you take a risk. So if you invest your money in a company, you are taking a risk. And when you take a risk, you are entitled to a higher return. See, without risk, you're getting 7. So if I'm going to take risk, any company where I invest, since there is always a risk involved, they have to give me more than the risk-free rate. Now, if they don't give me more than the risk-free rate, I will not invest. I will prefer to put my money in a place where it is risk-free. So suppose a company offers you 10% on its bonds. In that case, what will happen? It is offering you 3% more than the risk-free rate of 7%. So this 3% which you are getting extra is called the risk premium. Okay, so just remember these 2 points in risk and return. If there is a concept of if the higher the risk, the higher the return. If somebody offers you something at a low risk, then you can bet the return will also be low. So that is risk and return. These are fundamental things in finance, so I thought we should talk about it. The next thing which I want to just touch upon is the concept of an annuity. So an annuity is a fixed payment each year for a specified number of years. So basically, I just wanted you to get familiar with the word. The concept is pretty simple. Suppose you deposit 1 lakh with an investment company and they promise to pay you 10,000 every year for 10 years. Then in that case, that 10,000 which you are getting is called an annuity. Annuity is coming from annual. Okay, so per annum. Another example, a landlord gives you a flat on rent. You pay 1 lakh per year as rent. This is also called an annuity. You have taken the flat for 4 years. Okay, so from the landlord's point of view, it is an annuity. From your point of view, it's a payment. From the point of view of the landlord, it's a receipt. Now, along with annuity, you come to this concept about the future value. So suppose the landlord says that you pay him 1 lakh at the end of each year for 4 years. What is the future value of the annuity after 5 years? The first 1 lakh will grow for 3 years. The second 1 lakh would grow for 2 years. And the third 1 lakh would grow for 1 year only. So if you calculate this, you will get, so the first 1 lakh, beginning of the year is 1. After 1 year, it is 1,06,000. After 2 years, it is 1,12,000. The second one, then 1,19,000. At the end of it, you have paid 4 times. So the total will be 4,37,000. Simple calculation, nothing much, you can see it here. So this first 1 lakh, it will earn for 3 years. This second 1 lakh will earn for 2 years. The third 1 lakh will earn for only 1 year. So it's like that. You will pay 4 times. And in this way, you will end up with 4,37,000. Okay. Fine. So at the beginning of the 4th year, when you have paid this 1 lakh, it has not earned any money. So that's why I'm not showing any interest with this. But at that point of time, you have paid your landlord a total of 4,37,000. If the landlord had kept it in a bank and the rate of interest it was getting was 6%, then it would have been like this. So that's one point here. You can do this on Excel. The formula is like this. First of all, you will have to write, when you write the 1 lakh here, you will have to use a minus sign. Here. Write the interest rate always in decimals, 0.06. Write the number of periods. N per is number of periods. Write that here. That will be 4. And the future value FV is like this. What we have calculated manually, you can do this in Excel by simply putting the figures into a little table and putting this formula here. Equals FV bracket open rate, comma, N per comma, PMT comma, PV comma 0 and bracket close. Now, the logic of this is not, we are not interested in why the formula has commas, why there is a 0, why this is minus. That's not the point. You just have to remember that this is the formula. Make sure to place these things correctly. Make sure you put the minus here. You will get this figure. Which also means that if at all you are investing somewhere and you are investing it in, let's say you're always investing at the same time, like for example, in the case of insurance premium, you're always investing on the same date. And you'll be able to very easily know the future value you will get if you take any rate of interest. And you can, if you fool around with this formula, change the rate of interest, change the number of years, it becomes very easy in Excel to calculate this. So it will be helpful for you for any recurring deposit. A recurring deposit is like any deposit which you make again and again, same amount, and generally made after fixed intervals. So it can be after every month, it can be every quarter, it can be every year, whatever. Normally it is 1 month. In a bank, a recurring deposit is opened. You normally are expected to pay every month. So that's one point. Then another word which you should know is the concept of a sinking fund. So a sinking fund is a fund that is created out of fixed payments each period to accumulate to a future sum after a specified period. Basically what it means is, let's see if you can understand it from here. The companies create sinking funds to repay bonds on maturity. So company may need to repay rupees 10 crores to bondholders after 5 years. Suppose the company had borrowed 10 crore rupees and it had borrowed from a large number of people. All those people had been given these certificates and the company had promised that after 5 years, I will repay you this amount. So basically what will happen is the company after 5 years will suddenly have to make this full payment of 10 crores. Because it had borrowed 10 crores and as per the terms of the bond, the principal amount of the bond, 10 crores, has to be paid at the time of maturity. Now, if the company does not make any arrangement within those 5 years to create a little fund from which it can pay 10 crores, then what will happen is suddenly at the end of 5 years, it will have to repay this amount. So, how much should it try to put aside each year to have rupees 10 crores after 5 years? Think of this as a monetary goal. Suppose you want to have rupees 3 lakhs after 3 years to buy a car. How much should you save each year to ensure that the goal is achieved? And I'm giving you different goals here. For the company, the goal was to get 10 crores in 5 years. For you, maybe the goal is to get 3 lakhs in 3 years. Now, if this money which you are investing, you are assuming that you will get a certain amount of interest. If you put this money every year in a bank, obviously the bank will give you a certain amount of interest. In this example, the 3 years, 3 lakhs example, we are assuming that that particular goal, the interest is 6%. So in that case, your formula here for the amount which you will get will be, so the future value is 3 lakhs. Remember, we want 3 lakhs after 3 years. So I put 3 lakhs here. I put 3 years here. The bank interest rate is here. So what is the basic amount, the installment amount I have to, how much do I need to pay? I need to deposit 94,233 rupees approximately every year. If I do that, at the end of 3 years, I will get 3 lakhs. So any goal that you have in mind, you can very easily calculate exactly the amount that you need to get. If you an easier way of doing this, or let's say a more useful way of looking at this is, years may you convert this into months. So 3 years is 36 months. And this 6%, this you convert rate. Make this also a monthly rate. You will be able to get your monthly installment here. Or of course, if you're not so interested in the exact present value, you can simply do another thing. You can take this 94 and divide it by 12. So you know roughly that you need 8,000 every month to achieve this goal of 3 lakhs in 6 years, in 3 years. So this is how you can create a sinking fund to meet a monetary goal. Okay. So this was another very simple concept here. Now we come to financial instruments. Now here, in this part, Prerna, at least this is something new. So it is not a carryover from an older topic. So you'll find this, you're making a fresh start here with financial instruments. Now, please understand one thing. Any financial instrument, there is one thing which is, very unique in the case of financial assets, is that all financial assets, the instrument is just one of the ways of, let's say, showing that asset. All financial assets are backed by a commitment. All financial assets are backed by a commitment made by the person who issues the instrument. For example, if you go to a bank and take a fixed deposit, you are giving them money, they are giving you a certificate, just a piece of paper. So you are basically trusting the bank. Correct? You're not getting anything tangible. You are just getting a little piece of paper, but you have this confidence that you will get back your money and you will get interest as per the terms and conditions mentioned on that certificate. So if it's a fixed deposit receipt, if it states there that they promise to pay you 10,000 plus interest at the rate of 6% after 3 years, and that is equal to so much money, you expect to get it from them. Now, that means this fixed deposit is a financial asset for you. An asset is anything which earns money, which earns income for you. And it is also an example of a financial instrument. What the point you need to remember is, every single financial instrument is generally backed up by a financial commitment. The person who is issuing it, in this case the bank, they are committing to you to repay the money to you in 3 years with interest. So just keep that in mind. Any financial instrument is always backed by a financial commitment. And that commitment is backed by the law. If for any reason the company does not fails to honor its commitment, then it is legally liable to repay you. Otherwise, you can take that company to a court and the court will take action against the company. Now, here I'm talking about financial instruments in this particular unit issued by companies. So the first one are, so companies raise capital by issuing different financial instruments. Examples are equity shares, preference shares, bonds, and debentures. So we had mentioned bonds a little earlier. So here is another chance to again look at bonds. So debt instruments. A debt instrument is basically what? When the company wants to borrow money. When the company wants to borrow money. So there are two sources of funds for any company. In one case, it asks people to buy shares in the company. That means they become small owners of the company. In the other case, they borrow money and they say that we will return this money to you after a certain period of time. And during that period, we will pay you interest. So here we have the category bonds and debentures. What happens here is the relationship between the holder of the instrument, that means the person who bought the bond, and the company is that of a creditor and borrower. So in legal terms, creditor, borrower, the company is the borrower, the person who gave the money is the creditor. Just like if I borrow from a bank, I am the borrower, the banker is the creditor. Now, the bondholder has given credit to the company has borrowed money from the bondholder. So just so that you understand the words creditor and borrower, a debt instrument is issued for a specified period of time. 5 years, 6 years, 7 years, 10 years, 15 years. So whatever is the period of time, it's fixed. It cannot be extended. It cannot be shortened. That's one. Interest is paid after specified periods. So up till the time, let's say it says 5 years. 5 years, after 5 years, it will return whatever money you have given it. If you have given 10,000, it will return 10,000 to you. But between now and the end, when it actually returns the money to you, it will pay you interest. And that interest, in the case of bonds, is generally paid every 6 months. Every 6 months, they will credit that amount to your account. Principal sum is paid at the end of the period. So the amount which you gave it in the beginning, the principal, that will be repaid to you at the end of the period. The company that issues the instrument must secure the bonds by setting aside some of its property for the purpose. So basically, company that is issuing the instrument, the company that has issued the bond, to make people confident that it will return the money to them, even if it is not doing well financially, what they do is they take some of their assets, some of their property, and they mark it aside specially for the bonds, which basically means if for any reason the company is unable to repay, that asset of the company, let's say it's a factory building or it's an office building, that can be sold. That can be sold, and the amount from the proceeds of that sale can be used to repay the bondholder. So the basic idea here is that when any bondholder who is investing in the company, he has this confidence that I will always get back my money. That is the basic idea. If the bond is not paid, then the company will have to sell the property and repay the bondholders from the proceeds of the sale. Who conducts the sale? The sale is conducted by a government authority. The person who actually conducts it is called a liquidator. Liquidator means he is taking the asset and converting it into liquid cash. So, liquidator. So, this happens in the case of bonds. The risk is low as the instrument is secured by assets. So, the return will also be low. The same concept, what we had said a few slides ago. If the risk is low, the return will also be low. Now, the other type of instrument which a company uses to raise money is equity. So equity, remember, is the shares. You've heard of equity shares, the share market. So this is the instrument, equity. The company issues shares known as equity shares. The buyer of the share becomes an owner of the company to the extent of the value of the share. So for example, if the share is, each share costs 10 rupees and you buy 10,000 rupees worth of shares, so you have 1,000 shares. That basically means if I take this company and I divide it into lots of shares, each share having a value of 10 rupees, then in that case, you are entitled to 1,000 of those shares. It's like taking a cake or a pizza, you divide it up. Let's say you divide a pizza into 4 parts, and you say that each of those quadrants of the pizza is equal to, each slice is equal to 1 share. If tomorrow that pizza has to be sold, you will get that 1/4. The share is just like that. So the company issues shares known as equity shares. The buyer of the share becomes an owner of the company to the extent of the value of the share. As an owner of the shareholder cannot claim interest or a fixed return. Remember, if you are the owner of a business, you cannot claim interest. You will get a part of the profit. You have a right to the profit, just as you have a right to also support in the case of a loss. Because you are an owner. No? Since you are an owner, no, you will not get, you cannot simply say that give me interest. If you wanted interest, you should have bought a bond. You should have become a creditor and bought a bond. But since you are an owner, you will not get a fixed return or interest, except in one special case, which is called a preference share. But generally, the principle is that you will get a dividend. That means a share of the profit. If the company doesn't make profit, you will get nothing. Remember this also. So, in case the company becomes bankrupt, it fails, the shareholder can lose all his money. This is also something which nobody tells you when you buy the share, but this is understood. You are an owner. If for some reason that venture fails, the company collapses, it fails, then in that case, you will actually, and suppose there are no assets left, you will lose whatever money you gave. So, for example, I had invested 10,000 rupees in shares of Kingfisher Airlines. You know the famous Vijay Mallya case. Now, when the airline collapsed and Vijay Mallya managed to run away from here, all those of us who had invested in that, we lost our money. So we were owners of Kingfisher to that extent. But since the company itself had collapsed, all shareholders lost their money. Now, and the other thing is, if the company goes into liquidation, equity shareholders will be paid only after all the creditors are paid. So this means, think of it like this. Suppose a company has raised funds in this way. 500 rupees it raised from equity shareholders. 200 rupees it raised from bondholders. That means it borrowed 200 rupees. So the debt component is 200 and the amount of equity is 500. So they have total 700. And then let's say that over the years, they were able to make some profits and their assets finally came to, let's say, 1,000. Now, the company at this point, it went bankrupt, it failed. So when it failed, a liquidator came. The liquidator took control of all the assets of the company, the factory buildings, land, machines, whatever it had, stock, and it arranged an auction. At that auction, all these assets were sold. So once these were sold, let's say the company was able to get back from this only 500 rupees. Now what will happen is, from this 500 rupees, first 200 rupees will be taken out and given to those people who were creditors of the company. From the remaining 300, all the equity holders will be paid. So that means instead of getting back 500 rupees, which they had actually invested, they will now get back only 60% of that, 3/5. So in place of 500, you only have 300. So you will get back roughly 3/5, 300 over 500 multiplied by 100. So 60% you will get back. So that other 40% is a loss. This is the point in whenever you buy equity, you should understand right at the beginning that there is a possibility of loss. हो सकता है पैसा डूब जाए.
Sir, I had a question here.
हाँ.
I invest in Future Consumer Group.
Okay.
During lockdown. Okay. I made profit also. Some share I hold approx 1,000 of benefit. Now it's 0.
It's gone.
Now it's also not reflect in my account nowadays. Is there any chances that they will reflect again?
Future Group, if there is some sort of a acquisition going on with Reliance, I think.
Yeah.
So if tomorrow they come, if whatever dispute is there that goes and they are able to settle, then all the shareholders of Future Group will get some sort of a settlement. At that point of time, depending on how much money you have invested, you will get something back. But it is not necessary that you get back how much you invested. That will depend on the terms of the settlement. You are like a minority shareholder here. Na? So your position is the most, what shall I say, weak. Yeah, so it's just like my Kingfisher investment. Na? But yours is better. Future Group may at least both companies are okay. Nobody has run away. There are no criminal actions being taken against anyone. So you should be able to get back something.
Nowadays, it's not reflecting in the my Demat
account. Because it doesn't have a value today. No?
So, correct.
It will be there in your Demat account. But it won't
now, from after financial year, it's not available. From March, April.
That means then for all practical purposes, Vivek, you can write it off. You are already learning accounts, so you know how to write off. The write-off basically means that now it comes out of your own pocket. So if you don't know how to write off the accounting process, we will ask Deepti about that. Deepti, you can tell Vivek how to write off his money. Correct?
Yes, sir. Yes.
So next class, Deepti can show you. You tell her how much amount it is. She will tell you the exact accounting to be done. And you can take that money and write it down. Okay. Meanwhile, Prerna, you don't make any bad investments so that you don't have to write off any money. Same for you, Deepti. Okay. Now, please remember one thing in the case of equity. You can never sell your shares back to the company. Just like what in Vivek's case, he bought shares. He does not have the option of selling it back to the company. The only way you can sell a share is by selling it to some other person. And that deal will be done on the share market, on the stock market. So as far as the company is concerned, there is no difference. The share has just exchanged hands. Prerna has sold to Deepti, Deepti has sold to Vivek, etc. As far as the company is concerned, whatever money is there with it remains with it and will remain with it till the company exists. Okay, so just so that there is no confusion here. Any debt, if you are a creditor, if you have bought a bond, that is something which you will get back at the end of the term. But in the case of equity, there is no way of selling back to the company unless the company comes out with a specific buyback offer. Sometimes companies are, they want to reduce the number of shares in the market. They are comfortable that way. And they're willing to pay the shareholders to return their shares. If that happens, if that is a buyback, they take permission from SEBI and they're able to do that. Then that is a very, very special case. Now, the shareholder has the right to vote on all issues brought up in the meeting of shareholders and can hold an official position in the company. These are your rights. So whenever an annual general meeting is held, it is possible for you to vote in that meeting if any resolutions are proposed. For example, the resolution to pay or not pay dividend, or to pay dividend at 30% or 40% or whatever. Once that proposal is there, all shareholders will vote. You have the right to vote. Now, the other category, remember I said there is one category of share, which is normally in a share, you do not have the right to any interest as such, or you can only expect a share of the profits. But I told you there is one exception. That exception is the preference share. So these are similar to equity shares, but they have some features of a debt instrument. This thing is there. So for the purpose of calculating the equity capital of a company, a preference share is considered equity. Like suppose the company wants to know how much of it is debt, how much of it is equity. They will consider all preference shares as equity. So the company knows that the preference shareholder cannot ask for his money back, just like the equity shareholder. So it is treated as equity. But as far as the dividend is concerned, preference shareholder is generally entitled to a fixed dividend. So if the company makes a profit, if there is a certain dividend which is a part of the terms and conditions of the share, then let's say it is fixed at 20%, he will get that 20%. If the company makes a profit. If the company makes a loss, then what happens is probably he will get that dividend in some other year. When the company makes a profit, this area will be paid to it. If the company goes into liquidation, that means the company tomorrow collapses, liquidator comes, sells the assets. So remember, I told you the first right goes to the creditor and then come the shareholders. Now, within the group of shareholders, the preference share is given preference. So their rights will be looked at first. After they have been paid, only then will the equity shareholders be paid. So as equity shareholders, your claim on the company is the last one. After everyone else has been paid, only then you are paid. Just that is just to understand your thing there. Okay, so this was basically about the financial instruments. I want you to understand these three. Bond and debentures you treat as the same. Equity shares, preference shares. Because whenever you sort of look at companies, these are the three main instruments which you will see. So you hopefully you have an idea about these three now.
Sir, question one. Anyone can buy preference shares?
At the time of issue, at that time,
IPO.
At that time, if they come out, it's not very, nowadays it's very rare to see this.
Okay.
It is more of a theoretical thing, Vivek.
Okay.
Think mainly in terms of equity shares and bonds. That is the better way to think of it.
And second thing, just FPO. Sometimes company issues FPO. So what's the strategy behind that? They launching their FPO.
So let's say that a company first came out with an IPO.
Correct.
Initial public offering. So at that time, the company, let's say, was a private company. It now wanted to become a public company. So it offered is registered itself with SEBI, listed itself on the stock exchange. After that, it issued shares to the public, asking the shares to invest. So since that was the first time, they got, let's say, so it's called an initial public offering. First, initial is first. Let's say they raised 200 crores. They got 200 crores. They went about their business. The business went well. And then let's say after 5-6 years, they find that they have a chance to expand, but they need much, much more money. Now, where do they get that money? There are two options. Once again, either they can borrow or they can ask for more equity. Now, suppose the board of directors decides that it is better to go for more equity. We can, break up our company into more shares and then give it to the shareholders. Then in that case, the company will come out with another offer, offering its shares to the public. Now, since this is the second offer, it is not the first, it is after the first. Therefore, it is called a follow-on public offer, FPO. So basically, it simply means that there are certain opportunities for investment and earning which the company has and which it wants to do, for which it needs money. And that money it wants to get from the members of the public. And so it comes out to the FPO. That is the concept in an FPO.
Right. But since I remember, Yes Bank offered that time, means he issued the FPO.
Okay. So in the case of banks also, when banks raise capital, that is to expand their credit portfolio. Think of it like this. For a bank to give a loan, it is not sufficient to just have the funds with you. For example, in banking, what does a banker do? It borrows money from someone, from the depositor, and it lends money to the borrower. Whatever it borrows from the depositor, it pays him less interest. It charges more interest from the borrower. And the difference between the interest charged and the interest paid, that is the income which the person has, the bank has. Now, what happens is, as per the guidelines of RBI, it is not sufficient to only have the money to lend. That means if I have, let's say, 10 crores of deposits and I want to lend 5 or 6 crores, I cannot lend unless I have a certain amount of capital. You understand? A certain amount of capital is required. So, right. When the thing began, when the bank began, At that time, they had a certain amount of capital. Let's say it had 100 crores. On the basis of 100 crores, let's say they were able to give a certain number of loans. Let's say it gave 800 crores of loans. Okay. Now it wants to give more loans. But RBI says that you must have at least 8 rupees of capital to give 100 rupees of loans. And let's say they are falling short. They have already given, they started with 8 rupees of capital. They gave 100. Now they want to give more loans. But they don't have sufficient. They only have 8 rupees. So they have to increase this. They have to bring in more capital. That was the position of Yes Bank. So Yes Bank wanted to expand its portfolio. Before that, it required more capital. Because if it doesn't get more capital, it will be unable to give more loans. If it cannot give more loans, it cannot make more profit. You get the point? That is the logic for a bank to raise loans. Now that we've come to the end of this, Deepti, you're not saying anything. You're okay, na? You're following the discussion?
Yes, sir.
Fine. Okay, then now this is something which will be very, very familiar to Deepti, but just so that everyone is on the same page, let's say this is an extract from the balance sheet of a company. It looks like this. Okay, so on the left, we have liabilities. These are the sources of funds. So the capital comes here, the borrowings, the debt comes here. These are the current parts. That means these items here, cash, credit, bills payable, these are money which the company has to return to its creditors. And this money, the company has to return within 1 year. Here, these borrowings, long-term borrowings, is more than 1 year. So it comes in this part of the balance sheet, long-term. This is short-term. Therefore, it's referred to as current. Okay, so due in 1 year. So the main thing to remember here is current liabilities, 1 year. Liability is always when I have borrowed money from someone and that person has a claim on me. So I have to repay that money. That's the concept of a liability. Salaries payable, interest payable, rent payable, dividends payable. So what are these payables? This, let's say, salary is payable. My employees work during the month. So at next month, right in the beginning, I have to pay them salary. So this is a claim. Those salaries have, those employees have a claim on me for the amount of their salary. The bank I took money from. See, here you see this word cash credit. This cash credit is like a loan from a bank. Okay. So the bank has a right to get interest from me. They have a claim on me for amount of interest. So that is a payable. That is something I will pay. The rent. Similarly, I have to pay my landlord. The dividends. Another payable. I have to pay that also. So all these things have to be paid obviously within a month or 2 months, not more than that. So it's less than a year. So it is considered current. Now, this money that I got, especially this long-term part, how did I use it? Some of it I used for buying land and buildings. Some was for machinery. Some was for office equipment and furniture. And some money, I found it was better to invest it in some other company. In the name of this company, ABC, I'm investing in another company. Let's say you call that anything you want, XYZ, whatever it is, I have invested it there. Let's say I have bought bonds of that company. So this is normally referred to as application of fund. Application means what did I do with the money? I took money from here. This is what I did with it. These are all called capital assets. These are normally referred to as capital assets. So these assets are used by me to generally make, let's say we take the case of a standard manufacturing company, these will be used to make some finished goods. Those finished goods will be sold in the market. Now, when I begin to sell in the market, I will create current assets. So I will receive payments either in cash. Inventory is those goods which are not sold yet. They are still with me. I'll be selling them in due course. Bills receivable. I have sold some goods on credit. So whoever I have sold those goods to, they have not paid me yet, but they'll be paying me back, let's say, in a month. So that's a receivable. I have to receive that money. I have paid more taxes than I should have. I paid approximately, later on when the calculations were made, it was found that I should have paid less. So this amount will be returned to me. So that is a receivable for me. Now, if I take all this up, I add this side and this will always be equal. Okay. So the word balance here is that the assets and liabilities have to always balance. Okay. So this is one thing which you should just understand, have an idea about this, because whenever we talk about profit, loss, balance sheets, at least you should have a picture in your mind about what these things are. Other point here, which I wanted to explain here is concept of book value. Just a minute, just give me 1 minute, please. So the idea of, so we'll be looking at this when we get to our financial accounting part, but I thought maybe you should just understand this word now itself, the word book value. So the purchase price of any asset bought by the company is its book value. Whenever you buy something, whatever you paid for it, that is the value which is known as the book value. Every year, as the asset gets older, its value is reduced by a fixed amount. The general, anything you buy, as it gets older, it loses value. Anything which gets older will always lose value. Now, as it loses value, since this is an asset, a financial asset, or a physical asset, we will try to reduce that value by a fixed amount. And the fixed amount is generally based on the life of that particular asset. And that amount is known as depreciation. So every year, the book value of the asset is lower than it was in the previous year. Now take this example. Date of purchase is, let's say, 1st April 2019, and the price of the asset is 10 lakhs. Let's say I bought a machine. The machine cost 10 lakhs. So I create this in the machine, the machine account. I start with a debit. Anything which comes into the company in accounting, that is a debit. It is with me. So the book value is 10 lakhs. Now every year its value is reduced by 1 lakh. Why? We are assuming here that the value of this particular, let's say the life of this machine is roughly 10 years. You take 10 lakhs, divide by 10 years. The proportionate amount for each year is 1 lakh. So every year I am reducing the value by 1 lakh. So let's say that in a very theoretical world, after 10 years, the value of the machine is 0. The machine is also now of no use. So I replace the machine. I need to buy a new machine. So at that time, I will again get a fresh machine and start this process all over again. At the same time, since I am reducing my profits every year by this amount, see, this is an expense. This 1 lakh is an expense. So whenever I do depreciation, I am basically increasing my expenses of that year by this amount. If I did not do this, then in the 10th year, if I did it in 1 year itself, then my profits in year 10 would be less by 10 lakhs, which will be a big hit for me. So to even it out, I do it at the rate of 1 lakh every year. So my profits also reduce gradually, and there is no bump in my actual earnings. So it will go like this. The value will keep dropping. First year, it has gone to 9. After 2 years, to 8, to 7. In the 9th year, it is, let's say, 1 lakh. 10th year, I will leave 1 rupee in the account. This you should note. I leave 1 rupee in the account, and for the depreciation for that year is 1 rupee less than 1 lakh. So it is 99,999. Why 1 rupee? Because I need to show on my books that I still own this machine. Or tomorrow what will happen is, if this machine is sold, let's say you sell it at scrap value, then at that point, let's say you sell it for 5,000. Then this 5,000 rupees will go into your income amount. Sale of assets, it will go there. So I just thought maybe you should understand this concept of the balance sheet and depreciation and book value before we go to the next part. And the next part which we want to do is the capital budgeting. Now, normally when we say budget, so what do we mean by budget actually? What is a budget? Deepti, anything? Vivek, what is a budget?
We fix a certain criteria, like that means we had some segments there, means diversification. On that particular area, we will invest that much amount.
Okay. So I have a certain capital with me, and I decide where I want to use this capital.
Right.
That is a budget, basically.
Right.
So, for example, when the budget is made in Parliament, the government tells us that this is the income I will be getting. This income I will be spending on these things. So, let's say that I'll be spending this on the welfare of farmers. This will be for road construction. This will be for defense. So basically, I just decide where I will spend the money that I have. Now, in the case of a company, the special thing is that whatever money I invest, here it is not spending, here it is investing. So whatever money I invest, that has to be in a profitable business. That project should come back with a profit. So I have to make a decision before I budget. Is this particular project where I want to invest money, is it profitable or not? First question. Number two, is it more profitable than other projects in which I can invest? I have some more options. Let's say you have 2 or 3 options. You'll have to decide which one is at least financially rewarding for you. A place where you will get back more money than you invest. So capital here refers to the long-term funds available with the company. Remember that in the balance sheet we saw this, the long-term funds. It may be in the form of equity or debt. Think of balance sheet again. Now, budgeting is the process of deciding how to use these funds. Question that would arise are, what project should the company invest its funds in? Where should I invest? How to decide which of the projects is better? Suppose I find that there are 3 projects, A, B, and C, and it is possible for me to do any of these. Then a decision comes, should I go for A? Should I go for B? Should I go for C? How much profit will I actually make if I go for A? How much will I make if I go for B? And how much will I make if I go for C? So I will have to do some sort of, there has to be some method in which I will try to predict these profits. And those methods are what we look at in capital budgeting. So note, the company is subject to audit and is also accountable to its shareholders. So it has to be careful about in taking a decision. This is the main point here. So when the managing director and the board of directors of the company actually make this decision, they are aware that there are many people who are looking at what they are doing. If tomorrow they mess up, they don't make the right decisions, then they are accountable to their shareholders. And they can lose their job. So it is critical that they get this correct. The other side of it is, if they make bad decisions, the company will suffer. And if the company suffers, everybody will lose. Okay. So where should I invest? First thing is, remember when we began our corporate strategy sessions, we said that every company has a mission. It has a vision. As per that vision which you have and as per that mission that you have, you already know what type of work you want to do. So when you choose a project, you will have to keep that mission and vision in your mind. For example, if it is my mission to be as environment friendly as possible, then I will try to invest in projects which are not damaging to the climate, or at least less damaging. Only I'll try to do that. So, other aspect is, wherever I invest, I should manage to get a profit so that the shareholder value increases. Shareholder value means, if, for example, if I have a 10,000 rupees, if I have shares of, let's say, I have 100 shares in a company, the market price of that is 100 rupees. So the total value of my shares today is 10,000. For this value of shares to increase, it means that the market price of my share has to go more than 100. If it becomes 105, then I will have a value of, my shares will have a value of 10,500. It will increase. So that will only happen when there is a demand for my shares. And when will there be a demand for my shares? When my company will do well. When it does well, then things will get better. So a project that is likely to give the highest return, this can be one criteria. Where should I invest? Should I go for highest return? Some of the methods that we can use here are the net present value, the internal rate of return. So here, once again, the concepts of present value that we studied earlier, they once again come to our assistance here. And on the basis of those, we look at some of these different, very simple techniques, but which are in different ways, they continue to be there. So net present value. We take the old example. You are an industrialist. You have an industrial unit. You want to buy a machine that costs 10 lakhs. The machine has a life of 5 years. It is estimated that this will lead to an increase in your earnings by 3 lakhs per year. If you don't buy the machine and instead invest in another company, you can get 10% per annum. So see, here is the option. I have 10 lakhs. I can invest in another company. If I do that, I'll earn 10%. If I buy a machine and try to earn money, I will get 3 lakhs. After the project will last for 5 years. So in actual terms, I will get back 15 lakhs. Now the concept is that to understand whether I have actually made up, this is valuable for me or not, this is a good project or not, I cannot be satisfied with staying in terms of current value. I should always look at the present value. Because these 3 lakhs which I'll be getting every year, I'm not getting it today, I'm getting it in the future. So for that, I do this simple calculation. What we had looked at in the earlier section. So since I am getting 10%, if I invest in a different company, I will use that 10% as my discounting factor. And I will discount all my future cash flows, these 3 lakhs which I am getting every year, with that 10% 0.1. Here it is 1.1 to the power 2, to the power 3, to the power 4, and to the power 5. In each case, I will divide 3 lakh by this factor. I will get the present value of that. So the first 3 lakhs after discounting becomes 2,72,727. The second 3 lakhs become 2,47,000. The third 3 lakhs becomes 225. Fourth 3 lakhs becomes 204. And the last one becomes 186,276. If I add all these up, I get 11,37,236 in terms of present value. So in terms of present value, I gave 10 lakhs. I get back 11,37,236. And I'm discounting at 10%. That means I am earning, my return from this project is more than 10%. And it also means that it is a profitable thing. So what is the net present value here? It is basically, I am taking this total of all the discounted cash flows and I'm reducing the original investment of 10 lakhs. I get back 137,236. I have a positive value. Now, this means if I am getting a positive value, it basically means that I am in a position. This is a good investment in the terms of, yes, it will increase the value. It will increase my profits. My money will not be wasted. This point is there. And it is better than the 10%. See, my alternative was to invest this in a different company at 10%. This is better than that. What this calculation is telling me is that the return I'm getting here is more than 10%. That is why this figure is positive. If the return was less than 10%, this figure would have been negative because this amount would have been less than 10 lakhs. If the return was exactly 10%, then this would have been exact. Sorry, if the total of these was exactly 10 lakhs, then we could say that it is the same as this. Then there's no value. Here also I'm getting 10% per annum. Here I'm getting back just my money back. So in that case, it's up to you. You're not losing money, you're not gaining money. But if you are getting a positive figure, it means this investment of 10 lakhs in the machine is better than this 10% investment in a different company. This is what the net present value method is telling you. Now, here, the time is of the essence. The time is very important. So instead of 3 lakhs per year for 5 years, imagine that the project gives you 1.5 lakhs over 10 years. So it has and that other alternative is still there. I can still go and invest that money in a different company, and that company will give me a 10% return. If I discount now, every year I'm getting 1,50,000 for 10 years. And if I do that same calculation, where I divide each cash flow by a discounting factor, which is based on this 10%, then see, you are getting a negative figure here. The total of all these discounted cash flows comes to 9,21,685. You had invested 10, you are getting back 921,685. Therefore, you are getting 78,315 rupees less. This is negative. Since it is negative, it is a loss-making investment. This is the basic concept here. And I only find this out when I discount. If I were to only use the actual value of the money, if I just looked at that, then I would say that I invested 10, I got back 1.5 lakhs every year for 10 years. So I got back 15 lakhs. Therefore, it is profitable. But when I look at the timing of each cash flow, 1.5 every year, I realize that I'm getting back less. And since I'm getting back less, therefore, I realize that this is a bad investment. I should not make this. This also means that the return from the investment is less than 10%. You see, logically, if I'm discounting at 10% and getting less than 10 lakhs, the aggregate is less than 10 lakhs, that means that it is less than 10%. It is useful to know the rate at which the cash inflows will be exactly equal to the investment. That is, net present value will be 0. This rate is known as the internal rate of return. Okay. So the rule is, if NPV is positive, you can accept. If NPV is negative, you reject. If the NPV is 0, it's up to you. Whether you reject or you accept, which means basically that now you will decide on the basis of non-financial factors. Maybe since you know that you will not make a loss, NPV is let's say 0, it's neutral. Since you know you're not going to make a loss, what will happen is that you are now in a position to look at non-financial factors. Maybe this particular project where you are earning less, but you are not making a loss, is more climate friendly. Maybe it's good for you because of that. Maybe because it's this project is in that particular city in which the company is based. So it is something you're doing for your immediate community itself. On those non-financial basis, you can decide to do this. You can also do this in Excel. If you're doing this in Excel, try to do it like this. So these are the Excel columns here, A, B, C, D. These are the Excel rows. So let's say in row 3, A3, I put this minus 1,000. Discount rate 11%. Time periods 1, 2, 3, 4, 5. Inflows 3, 3, 3, 3, 3. So what I have done is I have removed the thousands here also. So instead of writing 1,000, 1,000, I have just written 1,000. Here I have just written 300 instead of writing 300,000. NPV is this. And the formula in this place, you will put the formula. The formula is this, is equal to NPV, open bracket, select this, B3. Then you select B4. Then you select B6. This 2G, EF, sorry, this should be F, to F6. Let me fix that. Okay, so here, when you make the formula, please remember, put the comma after each cell B3 comma, B4 comma. And when you get to this last part for this, put a colon here, B6 colon F6, or select. Put your cursor here and drag. Drag the cursor like this. If you drag it, you will get this will come automatically. Then you close the bracket and you will get this. So you're actually putting a formula in this cell where this figure is coming. I am only writing the formula here so that you understand. If you do this, and remember, this is the decimal point, 0.11. Other thing to remember is, this is a minus sign. Deepti, you can please try this on your Excel so that you can, have a look at how, if you change these in cash inflows, how this NPV will change. If you change the amount invested, if you change the discount rate, if you change the time periods, if you change the cash flows, you can change anything you want. It is up to you. Once you do this, this will change. This figure will change. Okay. Below, I have just written this for you. Assume that you have invested rupees 1,000. Inflows you have are rupees 300 each year for 5 years. The opportunity cost is 11%. This means that your next best investment option is 11%. The 3 requirements for the formula to work are the amount invested, the discount rate, and the inflow amount for each year. If you have these 3 things, to follow the rule, you can calculate the NPV of any particular project without any trouble. This is the formula which all of you should learn and get familiar with. So it will help you in the calculations of this sort. Now, the advantage of NPV method is that it makes the decision easy by calculating the return in terms of present value of the inflows. So if there are 2 projects that a CEO has 2 projects in which he can invest, he has to choose on the basis of the NPV, he will be investing 25 crores. So basically, in an Excel sheet, if this can be done, if let's say he says project 1, amount invested minus 25, discount rate is 7%, time periods, in year 1, he gets 6 lakh, it's 6 back, year 2, 7, year 2, he gets 8, year 4, 8, year 5, 8. What is the NPV? It is rupees 4.73. Why are we using this? Here he is getting an NPV of 1.77. I think there might be a mistake here. I'll check this and get back to you. But in any case, just for the sake of understanding, this amount is higher than this amount. So for the moment, please understand only one thing, that the higher one, if it is a positive figure, is something that can be the basis for taking a decision. I compare the NPVs of 2 projects. The one which is better is financially better. Please remember, I'm using the word financially because this is a financial decision you're taking. If there are other considerations, non-financial considerations, which are important to you, then those considerations will come first. So NPV is a good measure of a project profitability. Why? Because it considers the time value, the timing of the cash inflows is discounted. It considers all cash inflows over the entire life of the project. Since it yields a net present value, it is possible to add the NPVs of different projects. And suppose project A has an NPV of 10 lakhs, project B has an NPV of 5 lakhs. Both are positive, so they can be accepted. They can also be added to find out the cumulative benefit to the company for investing in these projects. Suppose you are doing multiple projects at the same time. You're not just doing one project, it's a big company. You're doing many projects. So you can find out the NPV of each project and then take a call. I'll just take a 2-minute break just to take a glass of water and then I'll be back. 2 minutes.
Sir,
Okay. Prerna, Deepti, Vivek, are you here?
Yes, sir.
yes, sir.
Prerna, did you understand the NPV thing? I'm sure you are not very confident about it. Deepti, I'm sure. Yes, Prerna? Did you get that?
Yes, sir.
Okay, fine. We'll discuss it again at some point. So basically, just remember this, that NPV gives you an idea of the amount you will get after discounting. So you'll get the present value amount after all the cash flows have been received. You already know the amount that you are going to invest. So you have two comparable figures, both in terms of their actual value, their present value. And it is easy for you to compare. Now, if the NPV is positive, the overall wealth of the company will increase. So this follows the wealth maximization principle. If I invest in a project, at the end of it all, I earn something from it. I get back more money in present value terms than I had invested. Then I am confident that I have made some money. The wealth has increased. Now we come to the tough part. What are the limitations of NPV? So the biggest problem is estimating how much cash flows will come over a long period of time. So suppose the project has a life of 5 years. For that NPV to work, I have to accurately forecast what the cash flow will be in each of those 5 years, in year 1, year 2, etc. And that is a difficult thing to do. The other thing is I have to accurately predict that the project will start in this year. Every year I will be able to make so much sales. I will have, and then I'll make so much profits. These predictions are very, very difficult to make. So that is one big problem with NPV. But it has to be done because you don't have too many options. It's for you to do this. So it is, then the other aspect is, it is difficult to estimate the correct discount rate. Over a period of time, the opportunity cost can change. You may have a certain opportunity today, which will give you a certain return. 5 years from today, that position will be different. Things will change. So the opportunity cost itself, that 10% discounting factor that I am taking, that is also difficult. You know, some people use cost of capital as the discounting factor. The basis being, if my cost of capital is, let's say, 10, and I'm getting a positive NPV, this means that my return is more than 10. So if I'm earning more than my cost, I'm making a profit. That is the logic. But even there, it is very hard to accurately know what your cost will be in the years ahead. Cost of capital is not fixed. Now that also keeps changing. So these two things are very difficult. That is one problem. Now the other thing which comes from the present value concept is the concept of the internal rate of return. So this is the rate of interest or discount at which the sum of the future cash inflows is exactly equal to the amount invested. So when I say that I invested 10 lakhs, every year I got back 3 lakhs for 5 years. Actual today's money terms, you are getting back 15 lakhs. Now, after discounting, there has to be some rate. So, for example, when we discounted at 10%, we were able to get that figure of 11,37,000. And we said that our NPV is positive. But if you think, like in terms of just theory, there has to be a rate. If I discount using that rate, then I'll get back the total of my future cash flows after discounting will be exactly 10 lakhs also. So I invested 10, I got back 10 in terms of present value. I did not make a profit, but I did not make a loss. So what is that rate? Where the NPV is 0. That means the amount I invested, the amount I returned are equal. So the NPV will be 0. That rate is known as the internal rate of return. If I know that rate, then it helps me to understand what should be my cost. Suppose I know that the rate is 10%. Then I know that my cost has to be lower than this. My internal rate of return is 10. The rate will be 10% in the project in which I'm investing. Therefore, my cost of capital should always be less than that. Otherwise, I'll end up in a loss. At a simpler level, think of it like this. Suppose there is a bond priced at rupees 100. The coupon, remember the coupon is, the interest rate is referred to as the coupon, is 15%, payable every year for 7 years. What is the return, keeping in mind that you will receive rupees 15 a year for 7 years? Note the present value of each rupees 15 will be less over the years 1 to 7. Naturally, you are receiving these 15 rupees in future time periods. So the earlier time periods will have a higher present value. The later time periods will have a lower present value. Now, it is difficult to find this manually, except by trial and error method. In Excel, the formula is simple. So in Excel, what I will do is, I will simply put these here, the amounts. Year 1, 15, year 2, 15, year 3, right down to year 7, I'm writing 115. Why? Remember, this is a bond. So since it is a bond, this money will be returned to you. That 100 rupees which you had invested in year 1, this one, this will be returned to you in year 8 at the end of 7 years. So when it is returned to you, in year 7, sorry, it will be returned to you. When it is returned to you, you will get 100 plus 15, 150. Now, if I calculate the IRR for this, you will find that it is exactly 15%. So when the principal is being returned to you, basically whatever rate of interest you are being offered, that is the IRR also. What is the difference between this example and the examples which we had taken earlier? In the case of, we said that we are investing in machinery and we are getting 3 lakhs per year. The difference is that there, I am not getting back the 10 lakhs I had invested in the machinery. I am only getting cash inflows from the income that is generated by that machine. 3 lakhs, 3 lakhs, 3 lakhs, like that. In the case of a bond or any fixed income instrument, where you are getting back the principal, the rate, the IRR is actually the rate of interest which you are offered. So if they say that 15% is the rate, if you do this calculation, you will end up with this 15%. If I say 10% in the rate and I change this figure from 15 to 10, this will be again be 10. Something to remember. It's an interesting thing. So the coupon is the actual IRR in the case of a bond. Please just remember that. Now, suppose you are going to invest 10 lakhs in an industrial project. In an industrial project, remember, you will not get back this 10. You invested 10, you won't get this back. Unlike the bond, in an industrial investment, you will not get your initial amount back. Because that is something you have invested in a machine or something, so that money will not come back to you. You have to earn on a year-to-year basis. This is what generally happens in a company. You make an investment, all that you will get is this. So if I want to calculate the internal return here, that same, I'm taking the same 1.5 here, the same 15%, 10 rupees, 1.5 every year. If I do this, at the end, if I calculate, the formula is very simple, equals to IRR, and I select this entire part. If you select this range, that means B1, this is B1, up till B11, this part here, I will get 8.144%. As simple as that. So here, since you know your IRR is 8.144%, you can now compare it with the opportunity cost of capital. So you know this. If today you know that there is some safer way of investing the money, this 10 lakhs, which will give you more than 8.144, then you are free to invest there. If it is as per the mission and vision of your company, it's as per the basic values of the company, be free to invest there. If not, then maybe you will at least know that I can invest here. If IRR is greater than the cost of capital, you can accept. If it is less than the cost of capital, reject. If IRR is equal to the cost of capital, then you may accept. There's a small mistake here, if you can correct that. Okay. Now, continuing with this, what I'm saying basically here is, see, one way of checking whether that 8.144 rate, remember we said that if I discount all the cash, the present value, all the cash flows that I get to its present value by the internal rate of return, then the total of the cash flows should be equal to the amount I invested, and NPV will be 0. So you can test it like this. If on an Excel sheet, you write all this, year 1 to year 10, you write in each year you are getting a cash flow of 1,50,000. Your discounting factor is 8144. So 1.08144. This is to the power 2 to the power 3, and this continues till you come here to the power 10. Each cash flow you discount by the factor below. You add up the present value, the discounted values, you will find that if you add them up, you will get exactly 10 lakhs. What that means is you invested 10 lakhs today. Over the next 10 years, the discounted value of the money that you got, the cash flows that you got, that is also exactly 10 lakhs. This is a way of proving to yourself that Excel gave you the right figure. When I tried that quick formula in the last slide in Excel, I found it was 8.144. To check this formula, I can simply do this. It will give you confidence in what figure Excel is giving. And you will know that it will also explain to you, help you to understand the concept of this IRR better. If this is the internal rate of return. This is the return at which the present value, the aggregate, the total of the present values of all the cash flows that I get over the life of the project will be exactly equal to the amount that I had invested. So basically, any amount higher than this will give me a positive value. It also means, like I said in the last slide, that if I am trying to arrange capital for this project, the cost of that capital should not be more than my internal rate of return. If that happens, then that means I am actually not creating wealth, I am reducing wealth. So, this IRR, NPV, these help a company to understand whether at the end of the day it is actually making wealth or it is depleting wealth. This is the main point here. So I'm again reiterating this here. If you want to invest, your cost of funds has to be less than. I've written 8% just as a way of rounding it off. This, I think, is a repetition of the same slide. Don't worry about this. Then the other thing is that it's also possible to compare projects where the timing of and the amount of the inflows are different. So let's take project A and B. In project A, the amount invested was 1680. The amounts of cash flows that you got, that means the amounts you earned, in year 1, you got back 1400. In year 2, you got back 700. In year 3, you got back 140. If you discount at 9%, you will get an NPV of 301. That means if you add everything at the discounted value, it will be 301 rupees more than 1680. It will come to say 19 1981. So 1981 minus 1680 will give you NPV, that is 301. The IRR will work out to 23%. Now in project B, same investment, 1680. Here, it is different. In the first year, you are getting 140. Second year, you are getting 840. Third year, you are getting the highest, 1510. Now, when you calculate this, you find that the actual investment here is, the NPV is 321 and the IRR is 17%. Now, in this particular case, this 23% IRR is mainly because the large inflows were received during the early part of the project. See, the large inflow came here. In this case, the large inflow came in year 3. Here, the large inflows received during the later part of the project. Here, okay? As per the NPV method, project B should be accepted as the NPV is greater, 321. As per the IRR method, project A should be accepted as the IRR is higher, 23%. Okay? Which should we choose? See, the answer is very simple. If you consider the following question, what would you prefer? More wealth or a higher rate of return? See, you are interested ultimately in creating wealth. The IRR part, if this conflict comes between the IRR and the NPV, let us be clear, we are interested in the money. We are interested in the inflows, the actual value of the inflows. So we will obviously go with NPV. But I just brought this to your notice, even though the same method is used, if the timings are different, the actual NPV and IRR may give you, let's say, contradictory indications. When the larger cash inflows are received towards the end of the project, the NPV will decline if the rate of discount is high. In the case, it is only 9% and hence the NPV is higher. This is another thing. Here I'm using 9%. If this discount rate was 15%, then this would have gone down. So many factors are at play here. But just to show you the maths behind this, you know,
is there any other formula we can cap? IRR is simple formula in Excel. We can cap.
IRR,
here you mention NPV, net profit value is 9%. So it's our recommendation what kind of profit we are gaining.
So you know exactly, in the case of NPV, you know that this is the money which you will actually get. See, IRR at the end of the day is a percentage. It's just a theoretical calculation. NPV, if your calculations are correct, if these are correct, these figures out here, 140, 840, 1510, if your estimates are correct, then it is always preferable to go with NPV.
Okay. If we had all the actual data.
So see, the thing here is, Vivek, you will never have actual data. You will never have actual data.
It means practically means I had a business, I had practical data, monthly, even I had monthly.
But when you are looking at the future, it is always an estimate.
Yeah, it's estimate.
Data is always an estimate. It is not something which you can actually...
That is called opportunity cost can be changed.
It is not 100% correct. You are making an estimate. If you are correct, if time shows that you are correct, good for you. But you may be wrong also. That is my point.
Correct.
Then there is another way of satisfying ourselves that project B is superior to project A. For this, we look at the incremental cash flows, difference between cash flows of B and A. So you can do this table. See, this is another way of looking at it. We said that project B is better, na? So look at the differences here. The difference is 140, this was 1400 in project A, so minus 1260 plus 140 plus 1370. NPV here of these cash flows is 20. Incremental cash flow. Okay. The IRR on the incremental cash flow is 10%. This is more than the opportunity cost of 9%. Remember, we said we are discounting at 9%. No? We are discounting at 9%. So if I do this exercise, I will end up with this. If the IRR is 10%. This 10% is more than this 9%. So this is also one way of convincing myself that I should go for project B. To summarize, project B offers all the benefits of project A, plus the opportunity for an incremental investment at 10%, a rate higher than the required rate of return of 9%. Therefore, you should go for this. So we'll continue with this tomorrow, the merits of the IRR method. And any questions that you have, Vivek, or which
no one is there.
So we will do that. Okay then?
Yes, sir. I already cleared my questions during the session.